Something major just happened, and most people haven't fully processed it yet. This week, U.S. Vice President J.D. Vance spoke to leaders from more than 50 countries. The topic wasn't politics or speeches. It was critical minerals, the raw materials the modern world runs on. And during that meeting, he made it clear, the United States is setting up a price floor system for critical minerals. That's not rumor. Reuters confirmed it. And here's the key part. Most headlines skipped. Silver is included. Hello, everyone. Welcome to John A.G. Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now let's get back to the market update. This is a big shift, a quiet one, but a powerful one. And before we even talk about what this means long term, we need to look at what's happening right now in the market, because the price action is telling a story. Over the last 2 days, silver has done the same strange thing again and again. It rallies hard, it pushes toward the $90 level, and then, right on schedule, it gets slammed down. Today, silver ran up close to $90 and then fell all the way back to about 83. That's an 8 to 9% drop. And just like yesterday, this drop happened during the New York trading session. Yesterday? Same thing. Up to $90, then straight back down. In both cases, the reversal was fast and violent. Silver dropped nearly $9 per ounce in under 3 hours. Gold did the same thing, falling more than $200 per ounce in that same short window. That's not normal trading behavior. And here's the pattern that's starting to stand out. Silver keeps failing to close above $90 on a daily basis. Every time it touches that zone, selling pressure appears. Now let's slow this down and look at the bigger picture. During Asian and European trading hours, silver tends to rise. Demand comes in, prices move up. But once New York opens, heavy selling hits the market, and prices reverse. We've now seen this happen 2 days in a row, up overnight, down during U.S. hours. That tells us something important. This doesn't look like weak demand. It looks like two different markets fighting each other. On one side, you have real physical demand pushing prices higher around the world. On the other side, you have heavy selling pressure during U.S. trading hours, mostly through paper contracts and derivatives. Right now, silver is trading around $86 as I'm recording this. That's still well below the key resistance zone near $90 and even further below the next technical resistance near $96.97. But here's where things get even more interesting. In Shanghai, silver prices are much higher. The local spot price is over $100, and futures are trading close to that level as well. That's a massive premium compared to Western prices, roughly 19% higher. So ask yourself this, if silver is really weak, why is it so much more expensive in Asia? That disconnect matters, because it tells us the selling pressure in New York may not be coming from people who actually want the metal. It looks more like paper selling, contracts changing hands, not bars moving. And now, right in the middle of this strange price action, the U.S. government steps in and says, we are setting price floors for critical minerals. That's not a coincidence. We'll connect all of this, the $90 rejection, the paper selling, the physical demand, and the new government policy in the next phase. For now, this is the setup. The pattern is clear. And the timing couldn't be more important. Let's break down what's been happening with silver in simple terms. Over the past couple of days, silver has been repeatedly hitting $90 and getting pushed back down. Think of it like a ceiling you can't break. Every time it tries to go higher, it gets slammed back. Here's the timeline. Asian and European markets, silver rises steadily. Physical buyers are accumulating metal. New York market, massive selling hits. Paper contracts are dumped and prices crash. This is happening over and over. Yesterday, Silver hit $90, then dropped to $83. Today, same story. Hit $90, dropped again, then recovered slightly to $86. So what's causing this? Physical demand overseas, real buyers buying bars and coins, pushes silver up during the night. Paper selling in New York at derivative traders dumping contracts pushes silver down during the day. This explains why silver's price keeps reversing around $90. Now let's look at the numbers. Western Silver Spot, $86 Western Futures, $86 Shanghai Spot, $102 Shanghai Futures, $1 Shanghai Premium, $16, 19% higher. That's a huge difference. The premium shows real demand for silver is strong, even if paper markets in the U.S. are holding prices down. So here's the takeaway. $90 is acting as a major resistance, but it's artificial. It is not because people don't want silver. It is because paper traders are controlling short-term prices in New York. The game changer. Price floors. Now let's connect this to Vice President Vance's announcement. Price floors are not about paper markets. They are about keeping actual production alive. Here's how it works. If the market price falls below the floor, the government steps in as the buyer. This ensures domestic mining stays profitable. Paper prices will have to adjust upward to meet the floor, not the other way around. Imagine this. Silver paper price is $86. The government sets a floor at $90 or $100. That means the market can't trade below that. Paper prices are forced up. This isn't a normal rally. It's a repricing event. And remember, silver is now officially a classified critical mineral. That makes this unprecedented. The U.S. government is treating silver the same way it treats oil in the Strategic Petroleum Reserve. In short, the floor guarantees a minimum price. Below that, the government becomes the buyer of last resort. This changes the game completely. Now that we understand the $90 pattern and the price floor announcement, let's look at what's happening with real, physical silver, the stuff you can hold in your hand, not just paper contracts. Here is the headline: 14.8 million ounces of silver delivery notices hit COMEX in the first 4 days of February. Let's put that in perspective. At the end of January, the February contract open interest was only 1,231 contracts. By the first few days of February, 2,155 delivery notices had already been issued. Do the math. That's 2.4 times the total open interest demanding physical delivery. In simpler terms, new buyers are stepping in and taking actual silver out of the market immediately. And they're doing it in a month that's normally not a big delivery month. February is a non-primary month, so delivery activity is usually very low, but not this year. This isn't just a blip. This is a clear sign that physical demand is relentless, even while paper prices are volatile. Market imbalance is historic. Next, look at the bigger picture. The one-year silver swap minus U.S. interest rates shows imbalances bigger than anything we saw in the 2008 financial crisis and the 2011 silver mania. That's huge. New highs could come faster than anyone expects. Remember, a sell-off caused by over-leveraged paper positions is not the same as real oversupply. Paper markets can crash, but if physical demand is strong, the market is fundamentally imbalanced, and that's exactly what's happening now. Central banks are quietly buying. Here's another layer. Central banks have been quietly but aggressively buying gold for years. China, Russia, India, and Turkey are buying at record levels. The total gold held by central banks just topped 5,000 tons, a historic first. Why does this matter? Central banks are long-term buyers, not traders. They don't care about daily price swings. They are building strategic reserves, and this massive demand puts upward pressure on all precious metals, including silver. Meanwhile, most Americans think, if we're not buying, the rest of the world isn't either. Wrong. Global physical demand is stable and even increasing, despite what the U.S. paper market shows. Risk and volatility. right now. We also need to see the risk environment. U.S. stocks are selling off hard. S&P 500 down 0.95%, losing $580 billion. NASDAQ down 2.4%, losing roughly $1 trillion. Russell 2000 down 2%, losing $64 billion. Geopolitical tensions rising. Iran nuclear talks canceled. Oil surging toward $65 barrel. Chinese gold ETFs seeing record outflows, $1.3 billion in 2 days. At the same time, Bitcoin and Ethereum are also falling sharply. All of this shows a risk-off sentiment spreading across global markets. Yet, in the middle of this chaos, silver physical demand is exploding, showing that paper selling does not reflect the real market. Now let's connect all the pieces: the $90 rejection pattern, physical demand, and the new U.S. price floor, and see what it means for silver. $90 keeps blocking silver. Here, the simple truth: silver seemed to close above 90. 2 days in a row, it rallied toward $90 during the global session. Then New York selling slammed it back down 8 to 9%. Technically, the 150-hour EMA resistance sits around 96.97, and that's the next level silver would aim for if it finally breaks $90. The current pattern is clear: up overnight, driven by global physical demand; down during New York, driven by paper contracts. This tug of war is keeping silver trapped, at least in the short term. Price floors change everything. Enter the U.S. price floor system for critical minerals, including silver. The floor is designed to protect domestic production. If the paper market is below the floor, the government becomes the buyer of last resort. Paper prices are forced upward to meet the floor. This is not speculation. This is policy, and it has real structural implications. If the floor is set above current paper prices, silver's market could see a repricing event, not just a normal rally. Think about it. The government just made sure that no one can sell or buy below a certain price. That's unprecedented for modern silver markets. Physical delivery confirms strong demand. Remember the 14.8 million ounces of silver delivered in just 4 days of February? That's 2,955 contracts versus 1,231 open interest at month end. That's 3 times the open interest in a month that's normally quiet. New buyers are taking physical delivery immediately, not waiting for paper contracts to settle. This confirms real demand is crushing paper volatility. Historic market imbalance. Combine that with historical market data. Imbalances larger than 2008 financial crisis and 2011 silver mania. Central banks buying gold at record pace. Global physical demand stable, not collapsing. All signs point to structural pressure building. The big question. Here's the unresolved tension. Paper markets keep rejecting $90 during New York sessions. Physical demand and government policy are pushing the other way. Which force wins? That will determine whether we test lower levels first or break $90 and move toward 96, 97 better resistance on the hourly chart. It's a tug of war between leveraged paper positions and structural real-world demand backed by government policy. 3 takeaways you must know. Price floor announced. The U.S. will set minimum prices for critical minerals, including silver. If the floor is above current prices, the market is forced to adjust. This is a government policy, not speculation. Physical demand is exploding. 14.8 million ounces delivered in the first 4 days of February, 3 times the open interest. Demand is relentless, even in a non-primary month. $90 pattern versus structural forces. Silver keeps getting rejected at $90, but physical demand and price floors are real forces. This could create a major breakout once paper selling can't hold it down. In short, paper markets are struggling to maintain control. Physical demand is at record levels. Government policy is about to redefine the floor. Geopolitical and market risks add volatility, but the structural story is clear. Silver is caught in a tug-of-war, but all the signals, historic delivery notices, central bank buying, and the U.S. price floor, suggest that a major move could be coming soon.